Welcome back to Real Estate Mindset. Good morning to you guys. Happy Monday. I hope you guys had a great weekend, and I hope you guys are putting your goals together for this week, and I hope you guys accomplish those goals. So got a really good video morning live planned for you guys. It's going to get a little spicy as we move on, but I wanted to start here. We should all know by now that it's not what we have going on, and this sounds ridiculous because we cover this all the time, but what we have going on right now is not a 2008. By this time, again, you guys, all of us, if you've been following, if you've been listening to me, how many times do we really, we compare what's going on right now to 2008, 1980s, 1970s. So we know that this is not 2008. There's things that are worse than 2008, and there's things that are better. And really, we can break down the three major factors that makes this different than 2008. That's really the bear narrative, right? The bear push, the other side of the coin to the housing market not crashing in prices. Now, the first thing is loan regulations. We know that loan regulations are different, much different actually, right now compared to 2008. That's fine. We also know this is a big one too, loan modification. Okay, so foreclosure prevention is a lot different now than it was back then. And then the other thing, guys, is the inventory. So we get all of those things. Now that we understand that, we can move on. And we've known that for about a year. But some of the things that are way worse than 2008, well, a lot of it has to do with unaffordability, the PE ratio, the payment to income ratio, guys, obviously all of that. But the overwhelming massive bubble, the bubble is much bigger. And another thing that I see differently comparing right now to 2008 is the health of the consumer. And we're going to take a look at that on some of the videos as far as the health of the consumer. I actually think the consumer was better off in 2008. I really do. I think consumers are actually worse off right now, especially because of that COVID money printing. But we're going to start our market update right now. Big shout out real quick, guys, to Trey. Trey, I see you there, man. Trey has been helping build the community on Discord. You guys check out the Discord. The link should be in my description. Big shout out to you, Trey. Love you. Love all you guys in the comment section. I see you right now. We're going to start, you guys, starting with the calendar. Okay, so we're going to start with the economic calendar. Really not too much going on this week. I've highlighted a couple things that I'm going to look out for. Like on Tuesday, we're going to have some consumer credit come out. Cool, right? And then we're going to have on Wednesday, Jerome Powell is going to speak on Wednesday. He's probably going to say the same thing that he always does, literally every single time he talks. And then on Thursday, we're going to have initial jobless claims. On Friday, we'll have consumer sentiment. So that's what's going on this week. Not a whole lot of stuff going on this week. So let's move on to the real stars of the show, the interest rates. Okay, so here's where we're sitting, guys. Now, I almost have no words on the roller coaster ride of this 10-year. It is not supposed to make such massive fluctuations up and down. I mean, if it's going up, we get it. It's heading up. But what's going on right now is this like jerking action, right? It's like whiplash. So there's a lot of whiplash going on with the 10-year. You guys want to know what's going to hurt the economy, what's going to bring the economy into recession? It's the 10-year. The 10 years I like to refer to as the economy crusher. We are up an astonishing 10 basis points this morning. It's like the market can't even make up their mind. This is really, really surprising to me. But again, you guys were sitting at 4.6. That's still elevated. And that happened very fast. Look how long it took us just to get to 4%. So I wouldn't freak out, but nevertheless, that is up. Last week, that went down substantially overall. Let's look at the shorter end, guys, which is the 1 month. Now, I like to call this, and you guys should be kind of getting a better idea for how the money flow is working, how the recession is coming, where the pain comes from, why things are happening. Again, just watch the money, right? The 1 month treasury is at 5.39. Now, we want this to be higher than 5.3 because remember, 5.3 is the award rate for the reverse repo market. Why do we care about the reverse repo market? Because that's the lifeline. We look at that as a lifeline to the economy, right? It's like it's being propped up from that reverse repo market. So we want the reverse repo market to go bye-bye. Now, let's go into the economic warning signs. So I'm going to go and show you guys the inversions right now in the 10 and the 2. Let's pull that up right here. So, a little bit of a whiplash is here as well. The 10 and the 2 is our measurement for when we're going to go into recession. Okay, this is our warning sign. If it wasn't for this, guys, we really couldn't talk about a housing market crash. Think about what I'm saying. If it wasn't for this, it would be a lot harder to project what's going to happen in the future because we would not have this historical precedence of caution. Do y'all understand? So when this uninverts and goes above this black line, usually we're in recession in 6 months. Okay. But remember, 70s and 80s, we could still go into recession inverted. So what's been happening here? You guys see this steepening? A steepening is when this is going up to uninvert. Okay. So I'm sorry, a reversion, right? I think the proper term is reversion and then inversion. So this is a bear steepening. Now, let me zoom in here and you guys can see, here's the result of the 10-year going down last week. So the result was basically it dropped to about 31 basis point inversion. We actually peaked, guys, this was crazy, at 13 basis points. I actually thought that it was possible that we were going to be reverted or, okay, uninverted. I know that's not the proper term, reverted in October, but that didn't happen. Obviously, you guys, it actually flipped, but we were very, very close to reversion. Not quite there yet. We're sitting at 26 basis points. Keep your eyes on that. This is very interesting. Now, take a look at the liquidity. So here's the economic liquidity, the reverse repo market. Still on that stair step. Okay, so it's not really going down. You see that here. There's still a lot of money out there. So hopefully the shorter end, the 1 month, maybe 1 year, is going to have a higher yield so that the money will continue to come out of here. But you guys can see we're still on that doorstep, right? And then here's the other doorstep right here, right? That little plateau. And then right here was a plateau. So I don't know when it's going to start going down again. Hopefully that will be soon. Let's go into the 5-year expectations. So here's what the market is. These are all the stuff we're going over, you guys, are just your basic forms to get a general pulse to the market, right? So if you're following this, you may want to bookmark this stuff. And that's what I'm really saying. And now the reason I'm referencing these charts usually every day we're doing a live is because this data actually updates every single day. So we can see the trends and the trajectory of those trends. But the 5-year break-even inflation, which is very, very important to the Federal Reserve as far as unhinged inflation expectations, it got unhinged. So we became starting to come unhinged. It got to 2.52. We're now at 2.32. This is going to need to go down more than likely under 2%. Again, the and it's crazy if you think about it. Why would the expectations of the market matter? Because the expectations do matter, right? What people do and are hoping for matters. It governs their approach, their beliefs, right? So anyways, you guys, it's sitting at 2.32. This is telling us we got a lot of work to do. Any of the people that are saying, they're going to lower rates, date the rate, marry the house. It's like, y'all, we don't even know when the rates are going to go back down because the entire market and Jerome Powell is saying higher for longer. There's still inflation. This is sticky inflation that you see here. Now, these high interest rates are starting to be felt around the economy. Here's Citigroup, okay? Big news out of Citigroup. Citigroup pursuing Project Bora Bora. Sounds like a vacation in the Caribbean because there is a Bora Bora there. However, it is not a vacation to a tropical island. This has to do with staff reductions of 10%. It's starting to be felt. It took some time. It took some time to run through the system, but we had an overwhelming amount of money printing from COVID, so it's going to take some time. But look at, guys, 10%. How much is that? You may wonder, right? About 24,000 employees. So Citigroup has 238,000, you guys, 10%. That is a substantial amount. Gone, dead in the water. Really, really alarming. And not only that, the unrealized losses from securities. Do y'all see this headline right here? I think that we forgot how much $1 billion is. As a society, I think that there's been so much money printing. Oh, we're going to get $1 billion, $2 billion, $3 billion. It's not normal. Normally, we're talking about millions, hundreds of millions, right? And now we're talking about billions and trillions. I mean, this is absolutely insane. Look at this. This is big time, guys. This is Bank of America's unrealized losses on securities rose to $131 billion. That's super scary. That's on securities, right? Do y'all see the problems here? That's Bank of America, $131 billion. Whoa. Let's read a little bit of this, guys. Okay, so this is what this says. So Bank of America reported unrealized losses of $131 billion on their securities in the third quarter, growing from the second quarter. But, and obviously the bank is going to say this, the bank does not expect the portfolio will generate actual losses in the long term. What do we expect them to say? Do we expect them to say that they anticipate losses? This goes on. Unrealized losses have come under scrutiny, by investors since March. What happened in March? At that time, Silicon Valley Bank sold a portfolio of its holdings at a sharp loss. Okay, so that obviously it caused the banks to collapse and feeling the worst industry turmoil, excuse me, since 2008 financial crisis. So this is a big deal. This is an absolutely huge deal, you guys. I hope you guys are understanding that. Man, I mean, it is starting to get felt. You know, the quantitative tightening starting to get felt. And I think the good news is this. I'm going to tell you guys the good news, and we're going to go into our next subject, okay? The good news is more than likely there's going to be no more bailouts until 2005, until we have a new president, okay? I have a hard time believing that they're actually going to be able to approve something. They're going to bail it out. There's going to be fighting. Next year during the presidential election, I remember we were talking about this in 2022. It's going to be about the housing market. In fact, it's already about the housing market. We're going to listen to some videos about what they plan on doing to fix the housing market, and it's all completely trash. It's all not the real solution. The real solution is like the institutional investing, right? We need the institutional investing to leave. But anyways, what I'm going to do now, you guys, is I'm going to go into new construction data. The reason I'm going to do this is, so, okay, in the Discord, someone sent a video in our Discord community about a realtor that made a video about me. And I don't want to use their name. I don't want to use names to help them grow. I don't want you guys to go over there to troll them. I want you guys to be happy in your heart. But let's just refer to this guy as Pizza Hut. All right. He looks exactly like a pizza delivery man. But they basically made a video about me regarding my shadow inventory. Okay. My shadow inventory video. So this person's point was essentially the premise is only 10% of new construction inventory is being reported on MLS. And that I'm wrong. I'm so wrong because the data is being reported to the US Census Bureau. Okay. So I'm going to show you guys how, and normally I wouldn't waste my time with bums like this, but I thought it was interesting because it actually, the video that they made verifies what I'm saying. It verifies what I'm saying, the need for additional regulations, for additional transparency, and the fact that it's not being reported on MLS. How are you going to find comps? And here's the thing, you guys, again, their point was I'm wrong because everything's reported on Census Bureau. The thing is, and again, I would normally not respond to such nonsense. Everyone knows that's in this industry that realtors don't use census data to find houses. If that realtor is using US Census data to find people's houses, he needs to go back to work at Pizza Hut. Because you don't use census data, okay? Because imagine if you had a client, you can't find anything. What do you tell your client? We got to wait 3 months for the US Census data to come out. And then we're going to look at the Northeast region to see how new buildings going on there. I mean, you guys, the stuff that I hear from these realtors is just about hate. They're spending their time talking about things that are completely petty, that they're wrong about, instead of talking about the real problems. And on top of that, in this video, they're like, Travis thinks that there's a conspiracy. There's no conspiracy. One day later, $5.4 billion conspiracy charges, National Association of Realtors. I mean, when I watched this, man, my initial response to this video was, this dude's having a midlife crisis. I wanted to ask if he was okay. I almost called the police to do a welfare check. That's how delusional this is. But regardless, if you guys want to know the US Census data, let me show you. So there is a lot of new construction that is being reported on the US Census data. But let me show you something that the person that was making this video failed to realize. And this is why, again, this video that this person made helped me solidify my point in the need of additional regulation. The thing is, guys, is everyone knows US Census data is absolute garbage. If you read the notes, this person's own data, their own data is proving my point. That's why I'm like, dude, I'm going to call the police. We're getting welfare check. Like, what's this guy talking about? Look at this, guys. This is from one of the first paragraphs on the US Census data. I'm going to read this, okay? Just in case anyone thinks that all the data is being reported on the US Census data. It's not even close. Listen, guys, they are, however, still subject to non-sampling error. The total quantity response rate for these estimates, is 76.8%. That's it. It's only, at best, it's reporting 78. How are you going to say all the data's being reported to the US Census data and not read the freaking paragraph? How do you do that? How do you make an entire video and not read the paragraph? The statistics in tables 2 through 5 in this release are estimated from sample surveys and are subject to sampling variability as well as non-sampling error, including bias and variance from response, non-reporting, and under coverage. So again, the problem here is we don't have enough transparency with new construction data. And Johnny, I'm not telling you who that is. I'm not telling you who Pizza Guy is. You're in the Discord. You're going to know. Don't be going over there harassing this guy. You want nothing to do with this guy. This is going to help make us stronger. The thing is, guys, again, the U.S. Census data is not showing us. And look at this. Okay. When we go here and we look at, okay, what type of building is going on? They're not even breaking down the rent. So it's saying that there's 1.5 million houses being sold, but they're being sold for what? For rent? For sale? It's not breaking it down, you guys, for SFRs, but it will do it for 2 units or more. So when we go to 2 units or more, it starts breaking down for sale versus for rent. But anything SFR, it's a mystery. It's a mystery. There's no rent stats here. Look at this. You guys, there's a huge problem in new construction. That's my point I'm trying to make to you. There's a huge lack of transparency. Also in this video, the realtor was trying to make a point that roughly 10% of building, like construction, new construction is being reported on MLS. So this guy was like, Travis is wrong because everyone knows only 10% is reporting on MLS. But I'm just like listening to this video and I'm like, again, what's wrong with you, man? I'm sure this guy like went to his wife and said, honey, review it. I'm doing so great. But it's like, dude, it's just the maniac. Okay, take a look. I'm going to show you guys MLS right now. Okay. And what we're going to do is I'm going to show you guys that it's way more than 10%. Okay. So we're going to look at all the sold property in the Tavola subdivision. Now, first of all, what you have to understand about Tavola is there's still construction going on. There's rentals, right? There's things like that. And they're still building, but right now there's probably 3,000 homes. Okay. So we're going to say there's 3,000 homes. Now, 10%, okay, 10% of 3,000, you guys, is 300. So there should only be 300 listings. Okay. Let's look at the results. Okay. Look at this. There's 2,050. This guy made this video. I'm telling you, complete waste of time. He's like 10%, roughly about 10% is being reported on MLS. No, it's not. Almost all of it is. Almost all of it is. What are these people talking about? You guys, there's 2,000 sold houses for new construction in Tavola. Do you see this? 2,000. What is that? 70%, 60, 70%? But we don't know that because it's still being built. But nevertheless, you guys, it's all here. What I'm saying is true. And here's the thing, guys. Here's where I want to end this segment of the video. By this point, no one should be surprised that the National Association of Realtors was found guilty of conspiracy for realtor commission. Think of a realtor doing a video like this. Instead of this realtor talking about be careful for the arbitration agreements in the special warranty deeds, be careful for the shadow inventory, be careful for the long contracts, make sure you have representation. Instead of doing that, they're talking about U.S. Census data and how I'm wrong. This is the problem with the industry. This is the problem with realtors. And if you go to this video and you look at the comments, it's one huge hate fest. So not only did this person give the wrong information, all the other realtors that hate me think that he's right. So there's this whole circle. I won't use the word, but the problem with that, guys, is now these other realtors really believe this person. And think about how bad that is because they represent buyers and sellers. So say one realtor represents per year, say 10, 15 people. Say 10 people believed what he said. That's 100 consumers that are in jeopardy of working with an absolute garbage, trash realtor. This is bad, you guys. This is so bad. So if you're a realtor, this is what I'm saying. If you're listening to this, if you made it this far, if you're a realtor, you guys, just stop the cheerleading and let's start talking about how to protect the consumer. If you're a realtor, I don't care, 1 year, 2 years, 1 day, 20 years, whatever. Let's start talking about how to keep the consumer safe. They got nobody else but us, realtors. They got no one else. It's us. Don't you understand that, realtors? I'm begging you guys, man. We need you. We need realtors to step up. I'm serious. I'm about to start crying. Oh my God, I'm so sad. I'm kidding. All right, let's go into the mortgage rates. I'm really sorry. That may have been a little bit too much. But anyways, I wanted to give you guys that. Let's go into our mortgage report now, right here. Okay. Now, they went down. Okay, so we were sitting, I think we got up to 8.03? I'm not sure, 8.83. But right now, you guys, it dropped 13 basis points. We are all the way down, right? All the way down. Are you joking? 7.38%. So yeah, it did go down substantially last week. But again, remember, you guys, how are we sitting on that 10-year? Look at the 10-year. 10 years up 11. Oh my gosh, that's crazy. 10 years up 11 basis points. So when this updates later today, this is going to be higher. This is probably going to be in check. Okay, I'm going to say 7.5. All right. So probably 7.5. All right. So reference that later. I'm going to guess 7.5. I don't know. It's going to update a little bit later. Now, okay, let's go into our amortization schedule. I'm going to cover this quickly. We'll get into the videos. We're almost done, you guys. Now, amortization schedule, I like to show people how much it really costs to purchase a house right now at a 7.5 interest rate, because truly your interest rate is more like 150%. If you get a loan for $328,000, that's it, just $328,000, you really pay back $826,000. So you got a loan for $329,000, but you're paying back $826,000. You guys just marry the house, right? And date the rate? Yeah, right. Give me a break. Anyways, so I like to tell people, okay, after you close, okay, recover, build your savings back up. You have to move in, you have to settle in, these types of things. But when you've recovered, pay your freaking amortization schedule down, because this is horrible, awful debt to be in. And in fact, you guys, if you pay this amortization schedule on the left here, you see the payments. If you pay down, let's see, $17,625, so $17,600, you pay 5 years off. 5 freaking years, $17,000 takes 5 years off. That saves you over the course of the loan approximately $120,000. So I'm going to continue to hammer away at this. This is how the banks get filthy rich. Filthy rich is the amortization schedule. Take a look at the affordability thing. Okay, look at this, guys. In order to get the average house, $412,000. The average house. Look at the salary I had to put in. $160,000. You got to make $160,000 to buy the average house? Are you kidding me? To afford, not buy, to afford the average house. You guys see my setup right here. And really what I did here, guys, is I put $1,000 in credit card and car payments and student loan and personal loans. It's actually a lot higher than this. But what I want you guys to pay attention to is how damaging consumer debt is when it comes to purchasing power. So if I were to have no debt, okay, if I were to have no debt, so we're starting at 412, but if I have no debt, it goes from 412 to 550. That is over $130,000 in purchasing power. So understand, you guys, unlike the 70s and 80s, consumers weren't in overwhelming debt. I'll even say in the early 2000s, we didn't have this many subscriptions. People are spending badly, you guys. People are spending badly. And I know some people have to, because it's really hard out there. The inflation is really overwhelming, especially for the lower class. Like the lower class is already feeling this. So my heart goes out to you. But it is what it is, guys. And we're going to go into our first video, which is about the health of the consumer. You guys may want to sit down for this. I'm playing this video because I want you to understand the narratives. The narratives out there. I mean, basically the narratives out there is the consumers are strong and they're paying down their debt. They're paying down their debt. So even though the balances of credit card has eclipsed 1 trillion and delinquencies are skyrocketing, the health of the consumer is great. I'm just old-fashioned, you guys. That must be it. I'm just old-fashioned. Anyways, here's our first video. I hope you guys enjoy. If you can, Johnny, everyone, can you tell me if the audio is okay?
Let's turn to another indicator of consumer health, credit scores. New data show that rising debt levels aren't necessarily putting a dent in people's scores. CNBC's senior personal finance correspondent Sharon Epperson here with the details. Hi, Sharon.
Hi, Tyler. You know, a new report shows that consumers' credit scores have held up even as they've taken on more debt. The report is from VantageScore, an independently managed joint venture of the credit reporting agencies Equifax, Experian, and TransUnion. I spoke with Silvio Tavares, the CEO of VantageScore, about the health of the consumer. This is what he told me in our exclusive interview.
The reality is the consumer is actually quite healthy. The consumer is not maxed out. They're actually reducing their overall credit and managing credit pretty well.
VantageScore finds the average credit score is now a healthy 701. The lowest possible score is 300. Below 660 is considered subprime, and 850 is a perfect score. Low unemployment and strong home equity are helping consumers, but delinquency rates on credit cards, mortgages, and auto loans are climbing. particularly among lower scoring households.
We are looking to see if a low-income recession is developing. We haven't really seen that happening, but we're watching it. And particularly in the case of delinquencies or late payments, we're already starting to see those lower-income, younger consumers having a tougher time keeping up with their payments.
On-time payments are the biggest boost to credit scores. Also, a key factor is how much credit you're using compared to your credit limit. Lenders use these scores to assess a borrower's ability to repay, and knowing those key factors and keeping them in line is really key to boosting and keeping your score.
What is the difference between a Vantage score and a FICO score?
Well, the FICO score has been more popular with lenders. It's been around for decades. Vantage score is a bit newer. But the thing to know is that they both have that range between 300 and 850, but they may use a couple of different factors to really gauge your credit score. With FICO score, you need to have at least 6 months track record with some credit line, whether it's credit card or mortgage or a personal loan. With the Vantage score, you don't even need to have a credit card for them to come up with a score for you. They may use rental payments, they may use student loan payments. So there are a lot of people that fall into that group that want a credit score and get one through Vantage
Get one
score.
through Vantage as opposed.
You guys, I don't know how some of these people even make it to the TV. I mean, there's so many things that they said just then that were wrong and not how things are going. Let me break down FICO versus Vantage. It is pretty cool. Vantage, first of all, student loans are on both. So I don't know what she's talking about. So you still get a credit rating on a FICO score with a student loan. But Vantage basically allows people that, okay, I'm going to put this in a nutshell. People that don't have established credit, allows you to use like your rent payment and your cell phone payment or utility payments as payment history to calculate a FICO score. So that's what Vantage is. And so that does help people that don't have established credit. And she didn't really explain it that way, which is really just shocking. You know, she's just talking about the health of the consumer. Let's look at the health of the consumer right now by taking a look at Dishwasher. Okay, so here's consumer credit cards. So she said that people are paying their credit cards down. Okay, so she said they're paying their credit cards down, but for the last 2.5 years, they have been exploding. And on top of that, you guys, consumer defaults right now with credit cards are skyrocketing, as are bankruptcy. So all of this is skyrocketing. And we just got done listening to someone that said the health of the consumer is great. Where do you see why do you see why I talk about realtors so long? So do y'all understand, if you're a realtor, who else are consumers going to lean on for real estate? We have to do a better job. As realtors, we have to do a better job. The consumers are leaning on trash. All right. So, man, I just really want, I really want the realtors to step up here. We're going to go into our next video, you guys. It's going to go into the lawsuits. It's going to go into the unaffordability. The lawsuits are huge. I'm going to say this right now, and I'm going to release an evening video on this, but National Association of Realtors is going bankrupt. They're going to go back. They don't have the money. They don't even have the money for the little lawsuit. There's way bigger lawsuits right now than that little one they just lost. The one they just lost is a little baby one compared to what's around the corner for them. It's really ugly, you guys. All right, I'm going to put this up right now. If you guys can, let me know the audio is okay.
The estate market is dealing with a host of headwinds, especially as mortgage rates hover right around 8%. And while the high end is holding up better, the lack of inventory combined with high rates are creating a lot of challenges for homebuyers. Here on set to discuss that is Scott Durkin. He's the CEO of Douglas Elliman. He's joined by our CNBC wealth reporter, Robert Frank. Welcome to both of you. First of all, Scott, thanks for coming in. Robert, just kind of set the scene a little bit here for us.
So, Scott, the number that popped out for me is the October sales contracts. If you look at apartments sold for $10 million or more, that was triple the number of last year. And it doesn't feel like that kind of market. It feels like a very stagnant housing market. What's going on at the top? The top is always sort of different from everything else. But why is that more so now?
Well, I think the $10 million market is strong because that market's not affected really by anything that's going on, whether it be interest rates or lack of inventory.
They're all cash buyers?
They're all cash buyers mainly, and they buy when they need to or when they don't. You know, they're a different kind of buyer. And in Manhattan, we have so much new development now that hasn't been sold before. They want brand new.
I want to ask you about new development because that's been fueling a lot of the sales for a lot of this year. Because if you are in a 3% mortgage, you don't want to put your house on the market. But because of the lending crisis we're in now, there's not a lot of new development in the pipeline or getting started. They can't get financing. Is that all going to run out next year? And what's that going to look like for the market?
Well, I think you're absolutely right. But a buyer might not realize that. And so,
But there's not going to be supply.
right, and so prices will go up again. So I think without that inventory in that pipeline, I would start looking now.
Well, that's a nice thing to be able to tell people is hurry up. Can we ask you about this lawsuit about real estate commissions? And what was your reaction to this? And what do you think the significance could potentially be?
Well, I mean, it certainly was a curveball in many ways. I've been licensed 30 years, and I've been doing the same contracts, and my agents and our buyers and our sellers, we've all been disclosing everything that they pay for and we pay for. And
But what would happen, for instance, if they say, whether or not that model fundamentally changes, that in order to get access to MLS or some, that you have to kind of open things up that way and it's no longer exclusive. I mean, Zillow's out there arguing today it would be a huge benefit for them. Maybe it would benefit the big technology players or something like that. I don't know.
I don't see the benefit. I think it will hurt the housing market in a way in terms of the sellers, and the prices could drop dramatically.
Your stock is down on the expectation that broker fees, especially for the buyer fee, will be lower. Therefore, income to Douglas Elliman will be lower because of this. Is that the case?
Yeah,
Investors have that right?
I think income for every agent in the entire United States. This is just not here. This is the entire country. And
Is what? Income's going to what?
well, if it does not if the appeal is not won, yeah, you're right. Whatever the listing agent will have
This guy's bad.
the power and
guy's bad.
also being paid the commission. But I think you can't just send buyers to 1998.
No, but
we thought
earning
that internet-
3% if you can find your own house online and
Get
go
'em.
there yourself, to pay a broker 3% as a buyer's agent doesn't make sense.
well,
right?
Well, you need someone to negotiate it for you.
That's the piece that for me has always been tricky about the housing market. Is if I'm buying dinner on DoorDash, that's one thing. I know what I'm getting. I want some fries, whatever. They get
Even
delivered.
then you get some surprises.
Well, but homes are the biggest purchases that most people make. And so saving a little bit on commissions versus getting the best deal you possibly can and feeling like there's trust, I don't know where that factors in this decision.
I think if you're going to go it alone, you're going to pay more. You might not be getting the home you wanted. I mean, at Douglas Elliman, we equally represent sellers and buyers. So for us, it's hugely important. We've hired the best legal counsel that you can get, and we are going to fight this.
But let me ask you this. If you look overseas, even developed markets like the UK, the average commission for a broker in the UK is about 1 to 2%.
Correct.
Here it's 5.5 to 6%. Why is it
Well,
so
let's not
different?
forget, the UK doesn't allow a second agent to come in with a buyer. It takes longer to sell because you're paying such little commission. Here, we split those commissions. We don't take it all for one side.
Got it.
We've always disclosed that. It's in every agreement. It's not like we deliberately did this. This is
You deliberately did it, sir. You can't fool me. You deliberately did that. Comment below. Let me know what you guys think. I'm going to throw up some stats real quick because Comic Lover loves to talk about things. Where's your comment, Comic? Where is your comment? Here we go. Okay, here we go. So Don't Move is like people, problem is people will just keep maxing out the credit cards they add. And that's true. There's no doubt on that. That's why the credit card game is so lucrative for these investors. Now, here's what Comic Lover said, and I really appreciate you, Comic. He helps keep me sharp. I don't agree with your so much energy being put on insignificant things, but I really appreciate you. Scores would be going down if that was true. So the premise here is everything's okay because the FICO scores are going up, right? But the thing is, guys, it hurts me. It hurts me. I think the FICO score. Let me tell. I have the data up on the screen, so I'm going to tell you now. The FICO scores went up 5 points in 3 years. 2 points in what? 1 year? Two. We're talking about 5 points in 3.5 years. Did they really go up when we adjust for inflation? I'm just kidding. It was a joke. I hope you thought that was funny. But let me show you guys the stats right now. I don't think they thought that was funny. I thought it was funny. Okay, but here's the stats right here. And another thing that this may say, guys, is the people with good credit are starting to get credit cards. Wouldn't that account potentially for an increase of FICO score? Wouldn't people with great credit getting in more debt be a problem? I mean, you guys, the thing is I just got 2 new credit cards. So I just got 2 new credit cards. My credit is in the 800s. So that's going to prop that up. But I got 2 credit cards because of the cash back. Oh my God. You guys should really rebudget, by the way, for cash back. But here's what I wanted to show you. So since October, and 2 years ago, okay, 2 years ago, you guys see here, 2021, October, 716. So in 2 years, the big hubbub in 2 years, and look at the trajectory. These guys are crazy. 2 points. So we don't want to talk about the overwhelming credit card debt because it went up 2 points. You know, but I see the point. I see the point. It's worth taking a look at. That's why I threw it up here. If I didn't think it was worth taking a look at, I wouldn't have thrown it up there. But I mean, come on, man. I mean, you know, if you're looking at the fact that it only went up 2 points and discrediting the way that consumers work and the trajectory, I mean, I think you're doing yourself an injustice. But I definitely respect comments like that. So here's the thing, guys. Wanted to read this real quick. Now, obviously, people are struggling with unaffordability. What that happens, banks make less money. Banks want a bigger market share. The risky loans come back to the market. We can see, and this is really depressing, we could see demand for adjustable rate mortgages jump 10%. So this is nothing like 2008, first of all, because it was a way higher percentage as far as adjustable ARMs or adjustable rate mortgages. But 10%, you know, that's a trend. That's saying people are purchasing houses that they probably can't afford, right? Why would someone take an adjustable mortgage if they can afford a fixed rate? I don't like it. I feel like this is another indication that people are overextended. People should not be getting adjustable rate mortgages. Sorry. Why would you do that? Like the US has a fixed rate. Canada, the UK, I think Australia as well. They don't have fixed rates. We need to be taking advantage of fixed rates in my opinion. Of course, we're going to listen to our last video, you guys. I think I'm doing really good in time. I wanted to make this a little bit shorter than normal. All right, so we're going to go into what rising interest rates are doing and what that means for potential buyers. So let's listen to this one right now, and I certainly hope you guys enjoy.
Some good news today. The Fed didn't raise rates again today. The bad news, the economy still sucks, particularly if you're looking to buy a home.
That is true. Right now, potential home buyers are facing a 30-year fixed rate mortgage that's inching closer and closer to 8%. But the rates have been creeping up for so long that the impact is now creeping up on home builders. Joining us now,
Is Jim Tobin of the Home Builders Association. Jim, good to see you. Thanks for joining us on the bottom line. So let's talk interest rates, impact on new home construction. How are you guys feeling it?
Oh, it's hurting us. Our builder sentiment is down over the last 3 months. They're finally starting to feel the pinch of these high interest rates that, like you said, are starting to creep up to 8%. The reality is that borrowing costs that our builders have to go through in order to buy land and develop it and put a house on it, it's hurting them. It's over 10% for some of those loans. But the real impact is that just home buyers are sitting on the sidelines because of those the potential for 8% interest rates. So the whole market is locked up. You got existing homeowners that don't want to move because they're sitting in 3 or 4% mortgages and they're not willing to trade those for 7% mortgages.
and that's part of the problem, right? The fact that those people are not moving at this point, and there's not a lot of inventory on the market. So typically, you'd expect at 8% borrowing costs, the prices would come down. The prices are not coming down the way we've seen them move inversely in the past, Jim. So when it comes to how to sort of break this market in some way, it's not going to be the mortgage rates coming down anytime soon, but the hope would be that you'd have new inventory, and that's why the home builders are even more important right now.
That's right. The first thing was good news today was that the Fed decided to keep rates steady. So that's the first move, that hopefully we get some sanity in the mortgage rates now and they start to come off their highs. But more importantly, the only game in town right now is a new home. In fact, we're making up a larger percentage of the for sale market. Almost 30% of the homes for sale are brand new homes as opposed to existing homes. So now is the time for the government to be a partner, fight those high interest rates by getting out of our way, which means lowering regulations, which means putting more land in the pipeline and giving us an opportunity to hire more workers, more skilled laborers. That's really what it's going to take. Policymakers need to help out the Fed here. While they combat high interest rates, we need to combat supply.
So, Jim, you're talking about the government partnering with you to actually lighten the load. I chaired the subcommittee on housing and insurance, dealt with the home builders quite a bit. And I'm going to pull this stat out of the top of my head that we talked about a lot when I was on the committee, which I think 30% of the cost of building a new home comes back to rules and regulations, many of them frivolous and stupid. And if there was some reform in how we have the rules around new home construction, that could also bring down the cost of home builders stepping in and engaging in a market where the home buyer actually needs more supply.
That's right. We're not anti-regulation, but we're anti-frivolous regulation. The real secret here is that when lawmakers, whether it's on Capitol Hill like yourself or in the regulatory agencies here in DC, or even at your local and state government, if they just took a moment to think about the impact of those regulations on housing, I think we'd have a whole different regulatory environment and more people will be able to afford a home in America.
I hear you. If they just took a minute to think about a lot of things, I think it would
That
be,
expectation is too high, Jim.
it would be a lot better. But
Think about the impact of the rules and regulations on the market. That would be shockingly refreshing. Jim Tobin, thanks for joining us. We appreciate it.
Shockingly refreshing. Did you guys find that video shockingly refreshing? Do we need to lower regulations? You guys see what I'm saying about? I think they're really missing the points here. The points being that institutional investing seems to be a pretty big problem. So real quick, Comic, where's Comic? I don't know. He put through, but this one's for you, Comic, and this is for you because I appreciate your contribution. Let me show you the credit. Let's go back to the credit cards because I hear what you guys are saying. But what I'm saying is, again, an adjustment in 2 points is not a big deal. But if you guys look here, even in this little error right here, 2006, 2007, FICO scores actually went down. But here's what I wanted you guys to pay attention to. Okay, so if everyone's maxing credit cards debt, your FICO score should go down because of utilization ratio. That's fair. But I want to point out that when we entered recession last time, FICO scores went up. Okay, so it's fair to say that based on the last recession, that FICO scores go up during hard times, probably as a result of the people that are in typically great situations with great credit feeling the pinch. Because again, how could we explain 2007 October to April of 2008 FICO scores going up while in recession? How could you explain that? So I think that what we need to be paying attention to be honest with you, is the actual balances and defaults and delinquencies. Although the FICO score could be an important thing. Let me just update something real quick. Did this update? This is still not updated. All right, well, I can't go over that with you. So what I'm going to do, guys, again, Comic, I appreciate your contributing a lot, man. Really appreciate that a lot. So I'm going to go into some Q&As right now, you guys, some really good stuff to talk about real quick. Here's one from House Hacker. House Hacker is an investor extraordinaire out in San Diego. This guy made money in 2022. Not because he foolishly rushed into the market. The reason I like House Hacker is he's very intelligent from what I could tell, made some great investment, and he doesn't have some huge ego. Like I can't get past ego sometimes. It's just, I don't want to hear the ego. It's just, why do you got to have an ego? But House Hacker, I love you. Thank you for your insights. I'm not telling you what to do, but you want the reality. It may hurt, but at least you can prepare for it. I listened to both and I become a better homeowner investor. So, okay, I remember why I threw this up here. So House Hacker makes a good point. I think what point he's trying to make is to listen to everyone. Don't just listen to me. Don't just listen to bulls. Listen to everyone. And that's why sometimes it's very rare, but sometimes I'll listen to hate videos made at me because I can learn from it. Right. But usually it's just petty and it's completely nonsense and they have like some midlife crisis meltdown. But still, I like to listen to other people because of their opinions. Now, I'll say this and I'm going to get hate. I like to listen to Meet Kevin. I like to listen to Meet Kevin because he has a different narrative. But thank God, at least he's using data. Okay. The realtors, most realtors that are bullish, they're not even using freaking data that's even real. So like listen to an opposing opinion, but make sure their opinion is really based on data, right? Everyone's entitled to an opinion. Austin, appreciate you. It's always nice to hear from you. Credit scores are a measure of how much money an investor can extract from you. As a point of reference, my credit score is like 500, no debt, always pays cash. Now that's the thing. That's why, so people that pay only cash, right? They should be excellent citizens, right? Excellent consumers, but people that pay cash typically have horrible credit. Why do they have horrible credit? Because it's not established. That's it. So again, in order to play the game of credit score, a lot of times you have to have the credit cards. You have to understand utilization ratio, which Dave Ramsey, That's my gripe with Dave Ramsey. He doesn't teach that. You should teach that and explain to people, if you do this correctly, you can have a drastic increase in your credit score. But there's a huge but. You have to be responsible with your credit card management. That's the but. Great comment, Austin. Comment here from Don't Move. Problem is people will just keep maxing out credit cards. Okay, I already talked about this. Here's comment again. Appreciate you. Don't Move. Appreciate you. Comment. We got good discussions. Okay, one more thing from comment. Again, man, I really appreciate these opposing, views. Not sure why you're holding on to this instead of the unaffordability, but again, I appreciate it. It allows us to talk. So Don't Move is like $300 limits will have a negligible impact. I'm referring to overall balances. And the reason I'm pulling this up in comment, this is no knock on you. I lost everything. So this is wrong. The statement is so wrong. It hurts me to read this because what do we know? Comic, if you're going to give advice, I love it. But let me help you grow now. Credit cards, okay, the balance, the actual amount you're approved for doesn't have a substantial impact on your credit score. What does? What am I always preaching about? What do we look for? Are we looking at balances or are we looking at utilization ratio? Don't forget that. It's utilization ratio. So when I lost everything, for example, when I had a bankruptcy, foreclosure, repo, and I lost everything and I had no way to rebuild my credit, the only option I had was to get a secured credit card. Now, secured credit cards required me to, for example, to put $100 down. Now, me putting $100 of my own money collateralized them to lend to me. But they only gave me a $300 credit line. My score went up 30 points. My score went up 30 points for a little baby credit card. Why? Because I started to reestablish my credit and the utilization ratio was low. It was like 1, 2, 3%. So I don't want you guys, and I'm not talking about credit card balances. Okay. So it's credit card balances and defaults, separate subject. We're talking about the algorithm and how credit score is calculated. So again, the predominant way for increases in credit score is super low utilization ratio. So, but to his point, to Comic's point, unfortunately, Comic, I've helped thousands of people during my career in real estate. Most people, and this is sad to me, most people that are in a challenging situation, that are struggling, when I enlighten them, when I say, hey guys, this is how credit works, they get so excited, Comic. They're like, yeah, we're going to do it. But what they do, Comic, they go get the credit card, they get it, and they forget everything I just said. And most people that I help, and this really makes me sad, just charge their credit card and make the situation worse. So to his point, he's not wrong. In a realistic way, that $300 cap dooms people because you can't get anything that's not going to increase your utilization ratio. That's drastic. And this is why, Comic, that I tell people to buy beef jerky. This right here is why. Because if you're buying one, that's what I did. So when I had my $300 credit lines, I bought a thing of beef jerky and my credit score is boom, 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 going up like crazy. But the thing is most people, when they get their secure credit card, they go out to eat, they get gas, and they blow up the utilization ratio and they make the situation worse for themselves. And that is why there is a huge but. It depends on your maturity to use your credit cards, right? But I mean, so it's those low credit lines are a problem, though. I mean, he's right; they are a problem because of irresponsibility, though. That's why the problem. All right, you guys. Really appreciate you guys. RNT, I hope you made. Okay, so RNT, go back. I did a little video just for you since you posted that video into Scored about I don't want to use names. Don't use his name. We're just say Pizza Hut. Okay, so I confronted Pizza Hut. Let me give you guys a little bit of updates on my channel, some really cool stuff that's about to happen, okay? So, channel update, all right? I am this close to starting to travel. I have my list of cities I'm going to go to. I'm going to be starting my journey. Again, I got to get my drone license. I'm going to drive to Dallas, and then I'm going to go to Denver, Salt Lake City, Boise, Reno, Sacramento, and then I'm going to go back out to Las Vegas, to the areas that I went to already to see if they actually sold those houses. And then I'm going to Phoenix. I'm going to go to Phoenix, guys. I'm going to go right back to Desert Oasis and Copper Canyon. I'm going to be like, you see, none of these sold. So I'm going to go back out there. I'm going to see, what impact that has. So I'm really excited. And also, you guys, I'm going to be probably putting out a lot less videos this week because the drone test, I'm going to try to take my drone test on Friday. And oh my gosh, what's in that book? Like, I just wanted to get some cool videos of a subdivision. The stuff that you have to learn to get your drone license is like, wow, it is brutal. But anyways, guys, now I just wanted to end by, just saying, every single person, whether we agree or not, I hope you're empowering yourself. And if you really want to know about home buying, please take my home buying course. I put all of the basics. It's just all the basics there. It's going to teach you guys just basics on wedge, on cash flow, what to ask a seller for, how investors think, just general information. I mean, just listen to it. You don't even have to do anything. Just listen to it. It's for free. And then also, guys, go to Discord. Everything's going to be in my description. Don't move. Don't move. I appreciate it. Travis, check out Financial Audit with Caleb Hammer channel. You will love it. I appreciate you, brother. I appreciate that contribution and that support. You didn't have to do that. Other than that, guys, again, everything's in the description. Hopefully you're empowering yourself. Absolutely love you. Happy Monday. I hope you guys are setting goals, and I hope you guys are conquering those goals. And if you're out there investing in real estate, you guys already know I wish you luck. Calm down, empower yourself, credit, income, assets. And I looked at a comment. What I meant to say is I hope you win.